Good afternoon, everybody. JD here with your Rational Trader Market Analysis Daily. In today's video, the fear mongers are running out of ammunition. Today, we got the CPI report, and boy, if it wasn't better than expected, the fear mongers, I guess, expecting the tariffs to somehow magically be expressed in the inflation report, even though the tariffs have really just begun and it's a little bit too early to expect. Maybe it was just wishful thinking on their part. Whatever the case may be, the CPI report really backed my own expectation of a deflationary bomb that is going off in not just in the United States, but across the globe. So fear is expressed in the markets via the volatility index. And so it's interesting to see how the volatility index this morning collapsed after the CPI report was released. And uh, uh, in fact, traded down into the low 16s, really for the duration of the morning trade. It wasn't until early afternoon that you got news of the U.S. Embassy in Iraq being evacuated, which, okay, did indeed lead to a volatility spike, which is the very reason why you have a arbitrage between the volatility index and the short volatility ETF, the SVXY. You can see here on the SVXY, we traded this in our Money Fortress account this morning, and the volatility index was down some 3-4%, and the SVXY was only up 1%. Now, with the volatility spike in the afternoon, you did have the SVXY reverse course. We actually closed our trade pocketed, oh, I believe it was like 69 basis points for the day. So we got out of Dodge, fortunately. That's one of the benefits of intraday trading, but I digress. Really, but still interesting in that it took a really unusual geopolitical event for volatility to spike. Uh, the volatility short ETF was only down 40 basis points, and the volatility index itself was up almost 3%. So you see how the arbitrage flipped, right? The volatility going up, you're not going to lose as much money in the SVXY when you have this very stubborn trade in the SVXY, which is only going to dissipate over time. Thankfully, I hope it takes another month or two because the general trend is a drift lower in volatility down to below 15. It's coming this summer. It may even get here before the middle of June. But the ultimately the SVXY is going to correct in pricing when traders capitulate and realize that fear is completely overblown. And the CPI report today was really just the beginning of the fear mongers losing their ammunition for the case of higher volatility, more selling in the markets, etc. Nope, I think the reality is, by the way, I'm not a fan of the bull market. I'm just explaining that we are in a bull market. Valuations are still very high, but I'm really just focused on where there's a discrepancy and an inefficiency in pricing. That's what being a rational trader is all about, right? And I see the pattern. It's in the volatility index. And this spike, by the way, this afternoon on the geopolitical risk, that's going to entirely fade. And even if it doesn't fade, even if the U.S. or Israel bombs Iran for trying to attack or cripple their nuclear capabilities, I think that's all simply a one-off type of event, and then the trend can go back into place. So I'm really not worried about it. In fact, if there's an increase in volatility early tomorrow, believe me, I will be hammering the and trading the SVXY again here because I've got an upside target on the SVXY of 55, and we closed today below 42. So that's all I have for today, folks. This is JD. We'll keep going back to that well on volatility day in and day out. As long as the wave is fertile, we'll be talking about it. So I'll be back tomorrow with another video. Take care, everybody, and we'll see you next time.